All right, friends, back for episode number 2 in segment number 6 regarding vetting buyers without a realtor, because you don't need one, right? And in this segment and this episode, we're going to break down a little bit more about the financial capability of our buyers. Obviously, not all buyers are created equal. They come in all shapes and sizes. We broke down a little bit about those different categories, the major categories of buyers in the last episode. And now we're going to talk about their financial capability. And this is where the pre-qualification versus pre-approval concept comes in. And furthermore, what a pre-approval really means, what information's been checked, and how to make sure you're checking that information if the real estate professional or lending professional on the other side hasn't checked it yet before you get into bed with these buyers. So let's break it down a little bit. Pre-qualification is kind of just a first look, right? The borrower walks into or fills out an application for online a particular mortgage broker or mortgage lender's application process, and that financial institution then answers with a, hey, we think based on what you've told us so far, we could potentially underwrite a loan for you at about this much. Pre-qualifications in our industry are really regarded as kind of useless. Without having corroborated and checked all the information that this particular buyer has issued the lending institution, the piece of paper saying that you're pre-qualified for XYZ is virtually useless, as I said. How can you have any faith or conviction in the fact that this buyer can actually attain the loan that they're after without checking the information that tells the lending institution what this buyer has told them is the truth? So then moving on to the pre-approval. Pre-approval is more of a green light. Hey, you've completed our application process. You've told us every last bit of information we would need to actually get started underwriting a loan for you. But again, as we've mentioned in previous episodes, it's less understood today that even after the subprime crisis, where banks got a little bit more serious on what was necessary from a buyer to actually approve them for a loan and give them money to buy a house. Previous to the subprime crisis, they were just giving away loans, guys. It was, stated income lending. You just tell the bank you own $600,000, you're making $600,000 a year, they'll lend you money based on that income, never having checked the fact that you actually earn that money. No wonder the entire mortgage section of our economy blew up, right? But now, even after the banks have implemented restrictions on that sort of thing, they can still issue pre-approvals based on stated responses to questions. How much money do you make? What sort of debt do you have? What do you do for a living? Et cetera, et cetera. And they can issue a pre-approval just based on your answers to those questions. Now, we've stated in previous episodes, and we will reiterate here, that any loan officer or lending institution worth their salt doesn't want to waste their own time. There are certain unscrupulous, I would say, professionals in the lending industry that will use the fact that they can issue these pre-approvals without corroborating the information as a sort of a tactic to gain more business. They will issue a pre-approval knowing that it could be completely useless. That buyer will go out to market, try to win a bid on buying a property, lose the bid, or in the best case for this lending institution, win the bid, and then the lending institution will begin the vetting process for this buyer. Whether it lives or dies doesn't matter. Now that buyer is deeply in their pockets, having given all the documentation they need to really get into the nitty-gritty on whether these people can survive the lending process. And it's all pretty much done without them having to jab the buyer for information before the buyer has found a property that they really like. Basically, they're using the fact that this buyer has found a property they love as incentive for the buyer to cough up all the different documentation that they need to really make a full underwriting process. Underhanded, and I think a horrible way to do business with people, but it does happen. Now, as I described, most lending institutions and loan officers are going to do that homework in the beginning. And certainly, you would hope that most buyers you'd like to do business with would want their pre-approval completely vetted. They want to know without a shadow of a doubt they can actually obtain the loan that they are purporting that they can obtain to become the best buyer for your property, hopefully. That being the case, usually you can have decent conviction and faith in a pre-approval that you're looking at and use that to understand the buyer that you're working with. Now, you need to ask those questions, however. Just because you've received the pre-approval from a somewhat reputable lending institution, you've heard of these people before, Bank of America, Chase, whomever it may be. Maybe it's a local bank. In any case, you want to ask these questions. We described our our lender questionnaire that we developed specifically for this purpose. You want to go through that exercise with every buyer, even if you think the pre-approval is pretty solid. Now, let's say you have done that homework, you've talked to the loan officer, you're asking all these questions. Understand, however, that there is a limitation, a legal limitation, and also a maybe industry norm, customary limitation on what these loan officers will divulge about their borrower. They're not going to tell you exactly how much money they make. They're not going to tell you exactly what their debt-to-income ratio is. They're not going to tell you what they do for a living. You can ask things like, have you run this buyer through a desktop underwriter? Have they issued you the adequate number of bank statements to corroborate their income? Do they see any changes in their debt-to-income ratio coming down the pipe? Those are valid questions that they should and will answer for you. Now, this pre-approval and financial documents in general are cryptic and difficult to understand, but if you've got a realtor, great. If you don't, seek financial advice to help you decipher these documents. And in addition to that, it's just going to tell you the financial picture. The entire rest of the ball of wax as to what type of buyer this is, are they a first-time home buyer? Just because they're using FHA lending doesn't mean it's a first-time home buyer. They could have had 6 other homes previous, sold them, bought, sold, bought, sold, bought, sold, and this is just their next home that they're going to live in. You can still access FHA lending. Now, my point in mentioning all this is that hopefully you've taken our prescriptions to heart. You've done everything we've asked you to do, and you took adequate time to temper your showing process so that you had a good chunk of time with each buyer to take notes about them, to chat it up, to extract information from them. You needed bandwidth, you needed attention to be able to actually understand who these buyers are and take detailed notes on their situation. Most people don't really have any problem in answering questions like that during the showing process. They seem innocuous. It's just small talk. So what brings you here? Why are you looking for a new home? Where are you from? You know, do you have a lot of children? Is this going to be a family home? Are you going to be accessing the local school districts? All of these questions matter. If you're asking about investing, you know, are you an investor? Is this your first time? Are you using this as a flip? Are you going to buy and hold? All of these questions and answers are very important to you when it comes time to actually choose a buyer. So hopefully you've taken it very seriously what we've prescribed to you, and you've done all these things. Those answers coupled with the financial picture that you're going to see from the pre-approval and all the questions you're asking from this loan officer are going to paint the entire picture you need to actually be able to choose a buyer. Now, further into the pre-approval process, we need to explore different red flags, if you want to call them that, little breadcrumbs that lead us to the way through the forest in seeing whether or not this is the right buyer for us. And one of those things is down payment, obviously, but the down payment coupled with the actual top threshold of their pre-approval. So it's not always the case, but most of the time a buyer is going to go for a pre-approval and then they're going to go shopping for a house for a period of days, weeks, or months. They're not necessarily going to update the pre-approval every time they find a house that they want to make a bid on. A savvy buyer will, however, because they are going to make sure that they're not showing you a pre-approval for a heck of a lot more when they're offering a lot less. So let's say, you know, your house is $500,000. Are they going to slap down a pre-approval for $700,000? And you know now that they can afford $200,000 more. You're going to juice them. You're going to dig your heels in, turn the screws, and try to get as much money out of them as you can. A savvy buyer may go back to his loan officer or her loan officer and say, hey, reduce my pre-approval to say, you know, something within reason, $550. So, you know, now it's not ridiculously over the top. However, that buyer is also demonstrating that they are not all the way at the top threshold of their borrowing power, which is important. If you as a seller are looking at a buyer who seemingly is stretching their means, is borrowing every last dollar they possibly can, and interest rates are already high in this environment, it's a red flag. What happens if the interest rates tick up? Just a little bit, blows up the loan. There's no way that this buyer can actually facilitate this purchase. They can't get their lending because the interest rates going up now force them out of the category they need to support the loan payments. If rate lock becomes a concern, if you're looking at a pre-approval that is 60 days old, most loans come with a rate lock, most pre-approvals come with a rate lock guarantee of somewhere between 60 and 90 days. It can change, but if you are looking at a 60-day-old pre-approval, you know, it's scratching your head a little bit. You need to go back to that buyer and that loan officer like, hey, you know, are we still good for 90 days? Because, you know, my transaction with this buyer may last 45, 60 days longer if something becomes complicated. We don't know, and we want to know that that buyer is going to get that loan by the time they actually need to borrow the money, which is not when they're giving you this offer. So lots of things to consider, and again, you know, seek advice of a real estate professional, somebody who's accustomed to these sorts of things if you need some extra advice. But that's as far as we'd like to get right now in terms of financial capability with your buyers. Stay tuned for episode number 3, actually, which is regarding investigating buyers' motivations and how that relates to their timeline in buying. We'll see you there. Deuces.